All right. Good evening and welcome to another Closing Bell Market Update here on this YouTube channel. Today is Monday, the 22nd of May, 2023. And here is today's agenda. We will start off by summarizing today's trading day, as always. And then we will move on to talking about the debt ceiling. We got some more interesting updates regarding the negotiations between the Democrats and the Republicans today. We also got some more comments from Fed officials, including James Bullard from the St. Louis Fed. Very, very interesting as well. We will also talk about some comments from Jamie Dimon, Mike, and Michael Wilson. We will talk about Micron and the China bet, and also kind of markets are waiting for the next catalyst for all the data points that will be released throughout the week, including PCE. All right, let us take a look at how the major US indexes performed throughout the trading day. Mostly a lot of optimism surrounding the debt ceiling debate. The S&P 500 was, however, little changed at 4,192.63. The Nasdaq right here, still the outperformer. Tech stocks are outperforming also mainly because of AI, up by around 0.3%, an increase to 13,849. The Dow Jones Industrial Average down today significantly by around 0.4%, and declined to 33,287. All right, US yields once again up across the curve, short and long end, belly of the curve. The 2-year yield now at 4.33%, and at the very long end of the curve, the 30-year yield at 3.97%. Now, a lot of hedge fund managers and in general investors, if you look back at history, it is a very, very good opportunity to step into long-term fixed income, like long duration fixed income at the very long end of the curve. For example, here the 30-year yield. It is a good opportunity to invest in those yields when the Federal Reserve actually pauses interest rates, meaning that the Federal Reserve is basically at the end of its interest rate hike cycle and no more interest rate increases will follow. Now, many investors expect that at the upcoming June FOMC meeting, we will actually get a pause. I'm questioning the meaning of the pause. I also believe we will get a pause, but I don't believe that this pause ultimately means the Federal Reserve is done raising rates, because it could simply be a skip, right? If the data continues to indicate a strong economy, if the inflation data continues to show sticky inflation, then the Federal Reserve might start to raise rates again. And if you're then invested in long-term fixed income, you're missing out an opportunity, because you will eventually see steepening of the curve again. And then that would be a good opportunity to step in. You should really move to long-term fixed income here at the very long end of the curve when the Federal Reserve is sure that it will not raise interest rates again. And if that is the case, then it is a great opportunity to lock in those high yields. Okay, notable decliners today: Micron, Apple, and Foot Locker. I want to explicitly talk about Micron today, down by 2.85%. We will get to that later, but China announced a sales ban today. Micron will not be allowed to sell its chips to certain Chinese companies, but we will get to that in a second. Notable upward movers, very interesting. Pacific West, like I said, I usually say this here in every episode, but Pacific West, very interesting. A bank here, a regional bank, was put under a lot of pressure around 3 weeks ago because of, or mainly after First Republic Bank was acquired by JP Morgan. And overall, the balance sheet looks relatively healthy. Western Alliance is in a similar state, but Western Alliance announced an increase in deposits, increase in insured deposits. So the balance sheet of Pacific West as well looks relatively stable. So I'm very happy that some confidence is now regained here in the banking sector. So I'm very glad that Pacific West once again today up by 19.55%, coming off from its very, very low levels. Okay, let's get to our first topic. The debt ceiling debate continues. Joe Biden and Kevin McCarthy had another meeting today. Let us get to some of the quotes from McCarthy today. He said that, quote, "We can get a deal tonight, or we can get a deal tomorrow," basically indicating that, negotiations are maybe picking up pace, right? They're starting to come to a potential conclusion. They're coming to an agreement, potentially Joe Biden agreeing to certain spending cuts, which will be required. Otherwise, the Republicans will not actually pass the bill. But he added as well that the Democrats and Republicans actually need to have an agreement on the debt limit this week, because June 1st is the official X date, the date where the US defaults on its debt. So it is very important that Democrats and Republicans reach a deal before that X date. Goldman Sachs, no, it was Morgan Stanley, exactly. They have made a report saying that the Treasury might not run out of money until June 8th or 9th, which could give negotiators more time to come to an agreement. However, the closer we get to this X date, to June 1st, the more investors will shy away from risky assets. So they will price in higher risk. It is very interesting. If you look at the T-bills, the 1 month T-bills, they have reached a record high yield to maturity right now. The yield is currently at a level of 5.718%, and that is a record high level for those 1 month T-bills. Very interesting. This simply shows you markets are becoming more nervous, right? The equity market is relatively stable. We're kind of waiting for that new catalyst at the moment, but the debt ceiling debate is definitely on the minds of investors. And the closer we get to that deadline, the more repricing of risk will actually happen in the equity market within fixed income. And you can beautifully see it here at the when you look at the yield on the 1 month Treasury bill. Now, JP Morgan equity macro strategist Dubravko Lakos-Bujas wrote on Monday that, quote, contentious debates such as the near default in 2011 should serve as cautionary tales of the equity market disregarding and then violently repricing the risk of a US default, end of quote. So he's kind of referring to what happened back in 2011. Equity markets kind of disregarded, they kind of ignored the debt ceiling debate for a while, but then suddenly they actually were repricing that risk very drastically as you got closer to that X date. But you need to remember is this current situation is not that similar to 2011, because we have many other issues right now, actually. For example, high inflation and just in general macroeconomic uncertainty. Now, Biden said today that, quote, now it's time for the other side to move from their extreme positions, because much of what they've already proposed is simply, quite frankly, unacceptable. It is very, very important, very interesting to me. I'm very interested in to what spending cuts Joe Biden will actually agree to. Democrats, for example, they will, I'm pretty sure they will not agree to, for example, making it harder for workers to acquire social welfare. That is something that the Republicans want to negotiate about a little bit. But very interesting to see what price cuts, spending cuts Joe Biden will actually agree to, because we will need some, right? Otherwise, the Senate and the House will actually not pass the bill to raise the debt limit. Very interesting topic, a topic that will continue to move markets in the upcoming weeks. I expect we will obviously get some more headlines about this topic throughout the week. You cannot, in these quotes from Kevin McCarthy, we can get a deal tonight, we can get a deal tomorrow. I remember he was very optimistic on Friday last week. Not on Friday, but on Thursday, the day before. McCarthy was very optimistic. We got some great headlines from McCarthy, a lot of optimism. Markets were up. And then on Friday, Republicans walked out of debt ceiling talks. So it is very important. Maybe don't read too much into those quotes. I'm very much looking forward to finally actually seeing an agreement between the Republicans and the Democrats. And I guess we just need to remain patient here and stay up to date. All right, let us get to more comments from Federal Reserve officials. We got comments from James Bullard here all the way on the left. We got comments from Mary Daly. She is the president of the San Francisco Fed. And over here, Neil Kashkari from the Minneapolis Fed. Now, James Bullard, the St. Louis Fed president, said that we need at least 2 more rate hikes because of a strong economic and inflation, because of a strong economy and inflation that is still too high. He said that, quote, I think we are going to have to grind higher with the policy rate in order to put enough downward pressure on inflation. I'm thinking 2 more moves this year, not exactly sure where those would be, but I've often advocated sooner rather than later. So James Bullard, a very hawkish Fed official, He has always been hawkish throughout this entire interest rate hike cycle. And he actually, like I said, believes that the current economic data does not support a pause. He believes we need 2 more rate hikes. An understandable opinion, right? If you look at the labor market, you simply cannot get wage inflation down. You cannot get inflation down if you don't get wage inflation down. And in order to get wage inflation down, you actually need to see a rise in the unemployment rate. If you compare the current number of payrolls, for example, during 2019, we had a 6-month average payroll number of 167,000. Now we're above 200,000. So the labor market is just incredibly resilient. Okay, we got some more very interesting comments from Neel Kashkari, the president of the Minneapolis Fed. He highlighted something I find something very interesting today. He made it clear that a pause does not actually mean that the Federal Reserve is done hiking rates. Instead, it should be interpreted as a skip. So he basically said, yeah, it's important for investors, for markets, to not be too optimistic about a Fed pause. Like I said earlier, don't jump into fixed income at the long end of the curve right away, because you need to consider the idea that maybe this Fed pause is not a complete pause. Maybe it's just a skip, right? The Federal Reserve monetary policy affects the economy with a significant lag. So the Federal Reserve, I think, can afford now, because of all the tightening that they have done, they can afford to look at the data now and see how it affects the real economy. But if the data, if at the June meeting they pause and until the next meeting they see economy remains resilient, inflation remains high, at the same, we don't see that economic weakness. We don't see that decrease in especially core CPI, core PCE. When the Federal Reserve sees that, they might hike rates again, right? You never know. We might all be underestimating macroeconomic implications of the COVID stimulus, right? You never know. So don't be too sure that this is a Fed pause. That is basically what Neel Kashkari said here, and I totally agree with him. So something that fixed income investors should be a little bit more careful about. So Neel Kashkari also said that, quote, "Let's take it one meeting at a time. I really want to let this information come through, not overreact one way or the other." He also feels, quote, "kind of comfortable waiting a little bit to see how things play out." So like I said, just kind of waiting how the previous interest rate hikes really affect the real economy. Now, Mary Daly here in the middle, president of the San Francisco Fed, indicated that the labor market is still tight. In fact, job growth is more than twice the amount required to keep up with the growth of the labor force. I guess it's a very tight labor market. Still, we have relatively high wage gains. And so that would mean for her, quote, that I'm going to come into the meeting thinking on the data side, the economy is just stronger, the labor market is stronger than I anticipated, end of quote. However, this is very interesting. Just like Jay Powell, she referred to the extent of credit tightening. She said that tightening credit conditions could be equivalent to 1 or 2 interest rate hikes. What you need to acknowledge here about the credit tightening, right? The senior loan officer opinion survey showed that credit conditions are indeed tightening. The Jay Powell follows a certain arithmetic. He basically takes the nominal rate, subtracts 3% inflation from that to arrive at a real rate of around 2%. And then he adds to that the effects of credit tightening and the effects of quantitative tightening. It is hard to put a quantitative value actually to the effect of credit tightening. It is highly uncertain, but you kind of know in what direction you're going in terms of credit tightening. Credit tightening is very important, puts a lot of downward pressure on the economy, downward pressure on inflation, could do a lot of work for the Fed. But you need to remember, if you look at high yield credit spreads, if you look at investment grade credit spreads, they remain relatively stable, right? And I referred to this many times. However, you also need to think about, usually I don't have the graph here right now, but the Financial Times, they created a beautiful graph showing that spreads actually start to rise with a significant delay. Like you start to see credit tighten, like tightening credit conditions, and then after that, the credit spreads start to rise. But right now, credit spreads are at a very low level. So something that you need to think about if you want to know to what extent actually tightening credit conditions are contributing to, in general, tightening in the economy as a whole. Yeah, Mary Daly also said that, quote, we could start to the lag effect from monetary policy could start to show through at any point in time. And when you add the credit tightening that we've been seeing to that, it means that there is a lot of factors pulling back the reins on the economy. In general, I would say relatively hawkish comments, especially from James Bullard, Neel Kashkari, relatively hawkish, indicating that a pause could also just be a skip. Mary Daly, relatively hawkish, I would say, acknowledging the resilience of the labor market, resilience of the economy, but at the same time pointing out that monetary policy affects the economy with a significant lag. All right, let's get to Jamie Dimon. He had a very interesting investor conference today. Let me just kind of summarize in a few words the most important things that he said. He said that the US economy is doing fine, but the banking sector is starting to show some signs of deterioration. And he also said, very interesting, that you should be prepared for interest rates going higher from here. So he definitely is also acknowledging the fact that inflation is sticky, not coming down significantly. At the same time, the economy remains resilient. I mean, think about it. The Federal Reserve expects the unemployment rate to fall to 4.5% by the end of this year. That would mean an average that the economy on average would have to lose 200,000 jobs starting now per month in order to actually get to that 4.5% unemployment rate, because the unemployment rate is still falling. We're now at 3.4%. So, and even though the Federal Reserve anticipates the unemployment rate to fall to 4.5%, they still think they will not cut rates, even if we see the unemployment rate fall to that level. So it essentially all comes down to the events in the banking sector, I believe. How far will credit conditions actually tighten? But other than that, the economy is resilient. And I actually don't believe the unemployment rate will fall to 4.5%. And even if it will, based on the FOMC outlook, no rate cuts, even in that scenario. Now, he also said that $84 billion from net interest income, that's what he expects throughout the year, which is basically an increase from the initial forecast of 81 billion. Basically, JP Morgan expects First Republic to give it an even bigger boost from rising interest rates. Very interesting comments definitely coming here from Jamie Dimon. Now, moving on to Michael Wilson. We also got some interesting comments from him today. Today's trading day has basically been mostly about debt ceiling and just in general comments from important people. Throughout the week, we will get much more sophisticated data, for example, core PCE as well, PCE deflator data, some more earnings reports. So we will look at them, we will analyze them. But these comments are obviously very, very important because these are incredibly experienced and smart people, especially here. The Federal Reserve officials can give us an idea of the further outlook for monetary policy. And yeah, I don't need to tell you how important Jamie Dimon is. Okay, moving on to Michael Wilson. The S&P 500 has basically traded in a range between 3,800 and 4,200 points in the past 6 months. And Michael Wilson actually said that what we're seeing right now is panic buying, so kind of FOMO, the fear of missing out here amongst investors. So he said that, quote, a bottom line from a technical standpoint, last week's price action showed signs of panic buying in our view. Rather than a short squeeze, the market was driven by the biggest winners as more market participants convinced themselves the next bull market may have begun and they can't afford to miss it. He continued to say that, in short, we believe this rally will prove to be a head fake like last summer's. Basically referred to the fact that elevated geopolitical uncertainty, the debt ceiling, a tightening of credit standards among regional banks, and the path of interest rates are all variables in the market. He referred to the fact that the current rally we are seeing is very narrow. It is basically tech-driven. It is AI-driven. And many analysts have warned about the fact that AI is kind of turning into a rally at the moment. Take regional bank sector, the regional bank sector as an example here. Regional banks significantly under pressure. I would argue these banks, given the health of the balance sheet of those banks, they're pretty undervalued. At the same time, you have the tech sector, very overvalued, the kind of a AI bubble is developing. So you should really consider stepping out, and I expect that actually to happen. Some investors stepping out of tech, realizing some gains there, because I don't believe we're ready yet to break out of that range of between 3,800 and 4,200 on the S&P 500. So I believe investors will start to realize some of their gains within the tech sector and maybe move them into the undervalued regional banks. Something that could definitely happen. All right. Another interesting topic today, China actually imposing a sales ban on Micron. They basically, China announced that Micron will be banned from selling some chips to Chinese companies. Analysts at Susquehanna, led by Mehdi Hosseini, wrote that, quote, the US could reciprocate and not renew export license requests by SK Hynix and Samsung. That could actually have a bigger impact on the memory industry supply than China banning the use of some of Micron's memory chips. Very interesting topics here in general. Geopolitical tensions are simply evolving here. It will be interesting to see how, these debates and disagreements will further develop. All right. Now moving on to the last slide here, the next catalyst. Like I said, today has been mostly comments from very, very smart, very, very important people, kind of hearing about their opinion. But this week will be very data driven as well. We will get a lot of data, including, like I said, core PCE. We will get, I don't have the schedule exactly in front of me here, but the PMI manufacturing data as well. Very important economic data that will definitely play an important role for the Federal Reserve in determining whether or not to raise interest rates again. Now, markets are focused on three things right now. The Federal Reserve pausing rates potentially at the next meeting, a banking crisis, and the debt ceiling. Regarding the Federal Reserve pause, it is important to continue to assess the data and listen to Fed officials. Obviously, the banking crisis, right now, we have not seen any new bad news yet. We didn't get any new bad news. So interesting to see how that will develop in the midst of the current interest rate hike cycle. And the debt ceiling, we will continue to get updates on that throughout the week. All right, that is it for today's stock market coverage. Have a great evening.